Good morning, everyone. Thank you very much for joining us on Morning Markets. To those that have been subscribing, thank you. For those that haven't, please do so. It ensures that you get the content just directly into your YouTube feed. In terms of what we've been observing in asset markets over the past 24 hours, equity markets continue to move higher. That was globally. If we look at bond markets, bond yields across the sovereign spectrum certainly came in yesterday, and that's probably a counterintuitive move given the economic data that we had yesterday. And I'll come on and explain that in a moment or two. But just looking at equity markets, S&P 500 in the US at a new all-time high, up 1.1%. Within that, very much led by the technology sector, and that plays into some of those comments that we made earlier in the week about the sensitivity of that sector to how the bond yield move, and bond yields certainly did come in yesterday. If we look at also just some of the commentary that we've heard from the banking sector, I've touched on this yesterday in discussing JP Morgan, but with Bank of America and Citigroup also reporting yesterday very similar trends, strength in their capital markets business, their investment banking business. But then if we look at the core drivers of a bank and bank profitability over the medium to longer term, it's about loans, the loans that they extend to us as consumers and to corporates as well. And that loan environment is pretty anemic. Loan growth is just not coming through as yet for the banks. And that's probably understandable at the moment when we think about how high savings levels have been, the inability to spend as people would have normally done so, and that's allowed cash to increase at the consumer level. And what we can observe is that consumers have been paying down debt. So that's just one of those things to note in terms of the performance that we saw from the banking sector. Turning then to the economic data yesterday, and this was very strong data from the US in particular, just looking at the strength in retail sales. If we look at March retail sales were up 9.8%. That's an exceptionally strong number, and it really speaks to that ongoing reopening of the US economy. And even if we exclude autos from that, we still saw retail sales up 8.4%. Within digging in a little bit further to that, it does speak to that gradual and ongoing reopening of the economy, because we saw spending in restaurants and bars increase quite significantly as well. Now, there are a number of contributory factors to that strength. We look back to February and we think about the weather in the US was exceptionally bad, so retail sales were weak, so there's a bit of a rebound coming through from there. But really, I think the two things that we can take from that is, one, the higher propensity of the consumer to spend as the economy reopens, and also the use of the stimulus checks making their way back into the US economy. And then just the other factor that spoke to ongoing improvement was really the initial jobless claims yesterday, coming out at 576,000, some 190,000 below expectations, and one of the lower levels that we've seen in the past number of months. So evidence of economic recovery continuing in the US and gaining momentum, or broadening maybe is a better way to describe that. We did have industrial production, that was slightly weaker, but I think that's a function just of where we have been in terms of that data. Looking at that and thinking about the improvement that we've seen, that would, I suppose, be thought of as inflationary, and we would see higher growth, higher levels of inflation with a negative implication for the bond market. It was very interesting yesterday then to note that actually yields came in across the curve in the US, and that fed into other sovereign markets, so we saw yields take a step down, and that's, I suppose, a little bit counterintuitive. Higher inflation, higher economic growth, we may have expected sovereign bond yields to move out on the back of that. So that's something for us to just see over the next couple of days, how the sovereign bonds markets, particularly the US Treasury market, behaves as we move on from that very strong economic data. And then thinking about strong economic data, really that's what we've seen today from China, and this is looking at their first quarter GDP. And there's very strong numbers. You'll see the headlines plus 18.5% year on year. But that's very much driven by that base effect. So it's much more important to look at the quarter on quarter performance to just see how we're continuing to track. And if we look at that, the quarter on quarter performance was about 0.6%. So that's evidence that really strong recovery that we've seen in China very much last year, and now we're getting back to, on the sequential basis at least, a more normalised growth environment there. Again, retail sales exceptionally strong for March, up 34% year on year. Again, a base effect. Looking at it sequentially, 1.8% improvement month on month. So that's the important figure for us to be looking at. And again, like the US, it's showing that recovery that's very much ongoing within the consumer side of the economy there. I'll leave it there for today, but please do look out for the podcast and also the weekly update from the investment team. Many thanks.
The True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.